Now, one of the easiest topics like corporate is alternative investments. There are just 7 readings, and a good news is that 7 to 10 percentage. So you can expect around 13 to 18 questions, which is a very, very positive sign. Okay, so not too much to study relatively compared to other big topics, but very high scoring. Okay, let's start with some of the interesting questions. Majority of the questions are actually from the first reading where you have so much of information, especially including the valuation. So, alternative investment funds term sheet, term sheet, term sheet describes what? Fee structure and investor requirements, correct? Fee structure and management biographies? No. Management biographies and investors requirements. What is management biography here? Management biography is basically is management's information. No, here the alternative investment term sheet is all about what the investor needs and what is the fee that the investor is supposed to pay. The management fixed management fees and incentive fees. So the answer is A. Understood everyone? All right. Correct. Yes. Next. Compared to traditional investments, alternative investments are more likely to be risky, right? They are more risky. They are transparent. No, they are less transparent. They are more leveraged. Yes, they take as much as leverage as possible. They are liquid. No, they invest in private security, so they are not relatively more liquid. So the answer is yes, B. KRD would like to start investing in a relatively small amount of capital into commercial real estate, and diversification among these investment is important. So I want to take an exposure to real estate, correct? But I also want to make sure that there is good amount of diversification, right? Which methods is he likely to use? Relatively small amount of capital into commercial real estate. Which option should I go for? Here, amongst the 3 options that I have, we have direct investing, co-investing, and fund investing. Which option? Which option? Direct investing, co-investing, and fund investing. Now, in co-investing, see, diversification is possible in fund investing, because in fund investing, you are going to be investing in a plethora of securities. Like, it's not going to be only in one fund. There is going to be in it's not going to be in one property. It's going to be in multiple properties, right? And relatively small amount. When you do direct investment yourself or with a partner, the investment is huge. In a fund, your proportionate investment is less and you are much more diversified. So, what is the correct answer here? Fund investing. You are a part of the fund. Understood? Why? Because diversification was important and I'm going to invest relatively small amount. If you go to buy yourself a property, you will have to pay a huge amount. Understood why C is the answer, everyone? Check, check, check. Clear? Right? Next. EDU is a hedge fund that has a 3 and 15 fee structure. What is 3 and 15 fee structure? Everyone? 3 and 15 fee structure. What do you mean by that? That means 3 is the management fee, 3 is the management fee, and 15 is the incentive fee, correct? Management fee and incentive fee. Compared to hedge funds with 2 and 20 fee, where 2 is management and 20 is incentive, EDU charges higher what? It charges higher this, which is management fee. Am I correct? Why incentive? No. EDU is charging what? Higher management fee compared to this. Isn't it, everyone? The answer is higher management fees. Correct? The 3 and 15 has got nothing to do with redemption fees. It is either management or incentive. Correct? Yes. Hedge fund management fees are most commonly structured as a percentage of hedge fund fees. See this, let me clarify here. Hedge funds fees are as a percentage of AUM, asset under management. But what about private equity, guys? Private equities are based on committed capital. Remember this. Hedge funds, AUM, private equities based on committed capital. Understood this? Clear? Okay, now amazing some questions where you are in exam also going to get Either to you'll have to calculate fees or you'll have to calculate returns for the GP or LP. Remember, returns are for the LP, fees is for the GP, general partner and limited partner. Okay. Alternative investment fund generated 18% return during this year. The manager has 20% performance fees subject to 8% soft hurdle. What do you mean by soft hurdle? Soft hurdle means you will pay the fees on entire gains. So out of 18% gain, your soft hurdle is 8%. So, and the catch up clause means you will get something extra as well. All right, everyone, right? What performance fee did the manager earn? Everyone, we've been given choice 3.6, 3.2, and 2. Guys, have they given us how much is the catch-up clause here? Have they given us how much is the catch-up clause? Catch-up clause? No, but I have here minimum 20% is going to be my incentive if the fund goes above 8%. Has the fund gone above 8%? Yes. So on the entire 18 percentage, I will pay an incentive of 20, that is 3.6 percentage. Why? Why this will be my incentive fee? Just because it's a soft hurdle. If it was a hard hurdle, anything above 8, that is 10 out of 18, if 8 is gone, 10 is left. On that 10, I would pay the incentive. So my answer is here, everyone, 3.6. Agree with me? Check, 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 check. Got it? Why 3.6, everyone? Please confirm. Right? Why 3.6? Because it's soft hurdle. Understood? A private equity provision that requires managers to return any incentive fee, resulting in investors receiving less than 80% of the fees when you take the money back of the incentive that you paid. Is it called high watermark, drawdown, or clawback? What is that word called as? Everyone in the class. That is called clawback provision. Clawback is where you can take back your fees. Understood? Clawback is a good thing for whom? Clawback is good for the limited partner. Clawback is good for the limited partner. It is beneficial for LP and not GP. Remember this. In 2 and 20 hedge fund fee structure, the 2 refers to everyone again. Very easy, very easy, very easy. 2 is going to be what? The management fee. Now, private equity. Private capital fund under that waterfall structure involves distributing profits as each investment is sold and subsequently shared according to the partnership agreement. Now, they are using the word each investment. When you are doing, see, there are only 2 arrangements, if you are aware. It's called American and European. It's called American and European. American is called deal by deal, and European is called whole of deal or whole of fund. Actually, many people don't know the name. So the question is solved if you know the name. So here, deal by deal and American are same. Whole of fund and European are same. So the one, of course, B and C are the same thing, right? So the answer has to be A. What is deal by deal? American. So each deal is valued separately. Each deal is used separately for calculation. Whole of fund and European are, by the way, same thing. Understood? It's just a trap. Which of the alternative investment fee feature is most likely benefit to the manager? When they say benefit to the manager, means who? To the GM, to the GP, general partner. Okay. General partner is the fund manager. Which one is beneficial to the manager? High watermark is good for LP. Clawback provision is also good for LP. Catch-up clause is good for GP. See, check here. Catch-up clause is good for GP. Understood? Compared to traditional mutual fund, hedge funds are more likely to feature lower leverage. No, they take more leverage rather, right? Higher fees, yes. Higher liquidity, no. Less liquidity because they invest in private security also. So they have higher fees. All right, everyone. Next, when compared to traditional investments, alternative investments are characterized by less concentrated portfolios. Yes, alternatives, no, they have more concentrated portfolios. Concentrated, by the way, is opposite of diversification. So their portfolios are more concentrated. They don't want to diversify. Less liquidity of assets held, yes. More regulation, no. They rather invest in irregulated or opportunities which are not under regulation also, right? So the answer is less liquidity of asset. Yes, that is the feature of alternatives compared to traditional. All right. Okay. Now you are going to get questions about calculation of either fees or returns. So those are these questions that we've put here make sure that you cover all the variety. Okay. EduCapital is a hedge fund with 150 million of initial investment. So let me write this 150 of initial investment. Now this is where I will write my beginning value. So this is my question number 13. Question number 13. My beginning value of the fund is, everyone, how much? 150. Correct? Now they've asked me here, the fund charges 2% management fee based on AUM at the end and 20% incentive fee. So management fee is 2%. Management fees 2% based on end, and incentive fees 20%. But along with incentive fee, there might be some clause. I'll have to check. Incentive fees and management fees are calculated independently. So you need to separate both. In the first year, EduCapital has 25% return. So guys, your returns are 25%. So your ending value will be 150 into 1.25. It is going to be 187.5. Out of this ending values, first thing first you will pay is the management fee. So let us calculate management fee 2% on this. So that is going to be 3.75. It's on the end of the period. And now in order for incentive fee, I need to check the incentive fee is 20%, but is there a hurdle or anything? And is it on the full gains or not? Let us check that. Have they mentioned anything, guys? Investors, no. If they haven't mentioned it, we consider it as a soft hurdle, means on the entire gain. So the entire gain is from 150 to 187.5, that is 37.5. On that 37.5, 20% is going to be your incentive. So that is 7.5. Am I correct? Check, 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 check. Are you getting 7.5? So what is going to be your net returns after adjusting for all? Your net ending value, your final ending value after doing all these adjustments, 7.5 minus 3.75 plus 187.5. Are you getting 1 to 76.25? Are you getting this 176.25? Check, check, check. Let me know. If you get this amount, 176.25, that's your ending value. Your beginning value was 150. What have they asked me? They've asked me after fee return for the year. So now if I see my amount, it's 176.25. That's my ending value divided by 150 minus 1. That's going to be my return. Let us find that. Divided by 150 minus 1, I'll get 17.5. Are you getting this? Check and confirm. Are you getting 17.5? Please confirm, everyone. All right, everyone. What did I do here? See, check here. From the ending value, I adjusted for management fee, incentive fee we paid on the whole gains. Clear? They did not say as hurdle, hard, soft, anything. So on the entire gains. Got it? Management fee, I did it on the basis of end of the year value because they said it's on the end. We don't assume, we rely on the information. All right. Next, 14th one, very important again. Let's see this. EduFund is a hedge fund with 125 million of AUM at the end of the prior year, that is at the beginning of this year. The fund has 1 and 10 fee structure. 1 is management fee, 10 is incentive. Incentive fees are calculated on gains net of management fees and at the end of the year. So it is on the end of the year net of management fees. In the current year, Edu Fund has 5% gross return. So they've provided me with the gross return of 5%. Investors after fee return. So guys, first of all, how much will be my management fee here? They said the management fee is at the end of the period. Guys, the beginning value was 125. So my ending value, let me put up the ending value here itself. My ending value will be 125 into 1.05. It has to be 131.25. On this, my management fee of 1% will be 1.3125. All right, everyone, correct? Now, for incentive fee, have they said anything about the hurdle? No, 10% is going to be the incentive fee. So incentive fee is on the gain. So the difference between 125 and 131.6, 131.25, that is 6.25 is the total gain. From this, they want me to subtract the management fee, net of management fee, that is 1.3125. On this, I am supposed to pay an incentive of 10%. So this minus 6.25 minus this on this 0.1, that is, I get an answer of 0.4938. Are you getting this? 0.4938, store it. So my total fee is 1.3125 and 0.4938. So this is going to be my question number 14. My total fee, management fee and incentive fee now I have is 1.3125, 3125 and 0.4938. So what's going to be my total fees? My total fees is going to be plus 1.3125, that is 1.8063. So now when it comes to returns, my ending value and the beginning value, my ending value was supposed to be 131.25. From these, I'll subtract the fees. So 131 minus 131.25, I'll get an answer of 129.4438 roughly. This is the answer that I get after fees. I'll write 129.4438 and the beginning value that we invested was 125, correct? Now what have they asked? They're asking us for after fee return on your investments. So we will do this, divide by 125 minus 1 into 100. I am getting something like 3.555, which is 3.56 percentage. Are you getting this? Check, check. Very good. Excellent. So the answer is positive A. Okay, not negative. Clear, everyone? Got it? Yes. Next, let us try the next one. Okay. A hedge fund has a 2 and 20 fee structure with a soft hurdle of 5% and a high water mark. Very interesting. Incentive fees are calculated net of management fee. The gross return of the fund is 15% in year 1, minus 10 in year 2, and 30% in year 3. Incentive fees for year 3. First of all, see the fund's value. This question needs to be done without calculation. So see what happened. Let's say initially the fund was at 100. Suppose it was at 100, correct? Then Just take the return. The first year, the return that they said went down by negative, no, it went by 15% up. So I can say it might have gone to 115. Then it went down. It went down means it must have gone down by 10 percentage. So let's say somewhere it went here. Then in the third year, it went up again by 30 percentage. So let's say somewhere it went on to very high. Okay. Now the incentive fee for third year, should it be 20% on 30 percentage? Means should it be 20 percentage, by the way? Can it be 20 percentage? 20 percentage? No, because there is high watermark. So incentive will be not on the entire gains. It will be only on the gains above 115, which is going to make it less than 20%, isn't it? So it should be less than 20% of the increase in value in year three. And they have said net of management. So after management fees, isn't it? Because of that one high watermark clause. Am I correct or not? So the question looks like I need calculation. In reality, it doesn't need calculation. You will be wasting your time if you spend too much of time in calculation. A is the answer. It cannot be equal to, and in no case it will be greater than 20%. How to know we won't use calculation, brother? You need to know by hard work, by patience, by learning, and by karma. You can do the calculation here, but see the logic here. The maximum you're going to pay is 20. How will you pay more than 20? So C is definitely not the answer. B is also the answer only if there is no high watermark. If there is no high watermark, then the entire gain qualifies for incentive because they said soft hurdle. So that is where you need to apply the logic. If you are going to spend your time on calculation, you're making a very huge mistake. All right. Understood this? Clear? That is the intention of this type of questions. Okay? That you get dragged into the numbers. Logic is first, numbers are later. Did we not study this in fixed income? Understood. Sometimes it's not all about calculation mechanic. It's about the logic. With respect to venture capital, now we are moving to private capital. The term mezzanine stage financing. Mezzanine is a financing just before the IPO, when the company is ready to go for the IPO, right? Is used to describe financing that supports product and development and market research. No, that is expansion related. Initiate commercial manufacturing, that is the preliminary stage or early stage expansion, right? Prepare for an IPO, that is called mezzanine. Mezzanine is a link between mezzanine floor. Have you heard about mezzanine floor? It's actually a link between the ground floor and the first floor. So same way, mezzanine is the link between the company at the nascent or initial stage and at the IPO stage, like expansion stage and the IPO stage. Which of the following types of private debt has lowest level of risk? Lowest level of risk. Yes, everyone. Mezzanine debt is risky because it is after the senior secured ones. Venture debt is very risky. Unit tranche debt. Why unit tranche? Unit tranche is a combination of various debt. Now I have a question. What is unit tranche debt? So those, I can understand if you've not studied from me, you probably will miss out on all this thing. But when we go to private debt, in this, I've put here unit tranche debt. It's like a combination of several debt. It's like a portfolio bundled, like an asset-backed security, a single bond, which is a combination of various bonds. So whenever I say combination of various bond, it's more diversified. So that is relatively less risky compared to the others. Understood? Unit tranche debt. Clear? See this combination of different classes of debt into a single loan portfolio. So that's diversified. The formative stage of VC investing, when the capital is furnished for market research and product development. This is the stage where you're starting, is best characterized as angel investing, seed stage, or early stage. Guys, angel investing is not a VC stage. This is a stage where you just have an idea. Once the idea, you want to put it up on the ground, that's where you will start doing the market research. That is called seed or early stage. Which stage comes before seed or early? Seed, right? So it's a seed stage. Understood, everyone? Seed stage. Early stage is after that, when you go into the production, and then comes expansion, and then you go for mezzanine and IPO. What is vintage year? Vintage year is the year when a private equity, see, vintage year, whenever you're going to compare to private equity, you need to compare them with the same vintage year. Vintage year is when they make the first what? Investment, or receives its first capital commitment, or sells it first. Come on, very important. Vintage year. Vintage year is when they begin to invest. So when the first investment is done, when they do the first investment, it is called vintage year. So see, many private equities take a lot of capital, but they will invest later. Some private equity take many major capital initially only. We don't compare them based on when they started raising the capital. We compare them when they actually started investing. That is a deployment phase. Understood, everyone? Next, what stage of life cycle is a company most likely to have a distressed debt? Distressed debt. Growth and startup, no. Distressed debt is when the company is on the verge of, it has exhausted or it has saturated. That is which company? Mature company, isn't it? Maybe it will go out of business, risky business. Nokia, maybe in the future, Apple, when they are not upgrading, right? BlackBerry happened that. That's where you are on the verge of suddenly extinguishing. That's a distressed debt. A private equity firm that provides equity capital to publicly traded company to finance companies restructuring, but does not take the company private. Very interesting. Is best described as engaging in. So you don't want to make the company, they don't want to make the company private. Understood. So what type of investment is this called as? This is called PIPE, private investment in public equity. PIPE, PIPE. See, there is VC, there is LBO, and then there is the third option, which is PIPE. About PIPE, there is very little information. PIPE is when you do a private investment in a public company. Your intention is not to make it private like a leverage buyout, but to keep a big stake in a public company. That's called PIPE, PIPE, PIPE. Understood, everyone? Right? Which type of private debt is least likely to have warrants? Means you have not attached anything with it. There is no need of any attachment. Warrants are attached to generally those bonds which are difficult to sell. Those bonds which are difficult to sell. Mezzanine debt are risky. Venture debt is risky. For that, to sell those bonds, you require to make it very lucrative. So that's where you will attach them the warrants. But when you're doing direct lending, there is no need of warrant to be attached. Warrant is attached when the bonds are difficult to sell. Those are risky bonds to make the bond attractive for investors to buy. Are you with me on this? Direct debt. Why not direct debt? Because this is anyway secure. In fact, this is actually the senior one, and it can be secured also. If it is secured, it is senior secured. So this is a senior debt. So it doesn't require anything to be attached to be sold. Understood? Clear? Yes. I got a answer. It is least likely. Yes. All right. You need to take a pause. I told you, take a 3-second pause. Deep breathe. Least likely means you're looking for the wrong answer. It's very common to make mistakes in least likely. All right. Next. This here. To exit an investment in portfolio company through a trade sale. Guys, there is secondary sale and trade sale. Trade sale is when private equities can exit through various options. See here. When private equities want to exit, they can exit through various options. Where is this? Private equity, yes, here. Trade sale, IPO, secondary sale, and so on. Trade sale is when you're going to sell your private equities target company or your portfolio company, which we call as portfolio company, to you have two options. See, the students are generally confused between, is it going to be selling to a competitor or is it going to be to another private equity? If you're going to sell it to a competitor, then it's called trade sale. This will give you a good value, and to the buyer, it is going to be a strategic investment. So here, when they say trade sale, means I'm going to sell my portfolio company to one of the portfolio company's competitor. For example, if I have a huge stake in, let's say, an e-commerce company, okay, a domestic e-commerce company. Now that private equities, they invest through VCs. Let's say they invested in a domestic e-commerce company. Now the best thing for them is to sell it to another e-commerce company, let's say Amazon. So that is called trade sale. But if I sell it to another private equity company, like let's say BlackRock, then it's called a secondary sale. All right. Compared to traditional bonds, private debt, they provide higher returns. Am I correct? Because they're risky. Higher liquidity? No. Low risky? No, they are more risky. Isn't it? So the answer is A. Now, many students ask me, are the actual questions so small and easy? I mean, so short and easy? Yes, they are. Okay. But still, if you notice, people do a lot of mistakes here. Okay. All right. Yes. The stage at which VC financing is used to fund market research and product development is best described as, we already did something similar to this. This is called a, which stage? The first thing that they enter is a seed stage, not early stage. Guys, not early stage. We already did a question like this. How can you say it's early stage? No, 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 no. See this. When do you enter seed? This is where market research and everything is. Early stage is where you start the production, commercial production. When you're doing market research, product development, and market research is still a seed stage. When you go into full-fledged commercial production, that's an early stage. Understood? So don't go by one word. See, to fund market research and product development, it's a one word together. Okay, don't just pick up a single word. All right, correct. Development, instead of development, they should say commercial development. Full-fledged commercial development is the early stage. All right. Investments in infra. Now we are moving to infra. Investment in infra that will be constructed in future are most accurately described as brownfield and greenfield. Of that, greenfield are the projects which are yet to come up. Okay. Now the thing is that there is nothing like open field infra investments. So there is either a brownfield or greenfield. There is nothing like open field. Okay. If there is anything, I don't know. It's not even there in the syllabus. Which of these is an example of social infra? Social infra is generally done for some social activity. Of course, it is done for the benefit of the society. It's not for commercial purpose alone. So, which one is it? ABC, railway systems, public hospitals, or data centers? It is public hospitals or sometimes prison, garden. These are social infrastructure. Social infrastructure includes healthcare related thing, housing, social housing for old age or orphanages. Those are done for basically not for economic purpose alone. So they are called social infrastructure. All right, everyone. Which of the type of infrastructure investment has the highest risk and highest return profile? Greenfield, isn't it? Greenfield, high risk, high return. Correct. Brownfield and secondary stage. Stage is under the brownfield only. Greenfield is risky. Which of the following is least likely a unique risk of property development? Property development is like infrastructure development. In those, one of the biggest risk is regulatory risk. Okay. Default risk, construction delays. Which one is unique? See, again, the word is least likely. So first, which one is unique? Regulatory and construction delays are unique, right? Which one is not the case? Default risk, because it is common in other types of investments also. Again, the question is least likely. All right. An additional risk of direct investment in real estate, which is not typically a significant risk in a portfolio of traditional investment, is risk of direct investment, which is not there in other places. Okay. When you do traditional investments like equity, what is that extra risk? Liquidity, market risk, or counterparty risk? Very easy. Which is typically not there in a traditional investment, in a portfolio of traditional investments. Everyone, A, C, I've got two choices. No one is looking for B. See, direct investment in real estate, the biggest issue is that how do I sell it? Liquidity risk is the biggest risk in real estate, isn't it? Market risk is common in equities also. Counterparty risk is there in derivatives also. Liquidity risk is more significant in the real estate compared to other assets. Are you with me on this? So relatively, which risk is bigger here? It's the liquidity risk. Real estate is difficult to sell. Other risks are there in traditional assets. Similar. Understood? Check, check, check. Now, when the carrying cost exceeds the benefit, remember the formula that we did, no arbitrage formula, forward equals to spot into 1 plus r to the power t plus the present value of cost minus the present value of benefit. Now, guys, here they are saying if the carrying cost exceeds the benefit, that means this is higher, right? So then the forward will be higher than spot. Am I correct? So then the forward will be higher than spot. Whenever the forward is higher than spot, what do we call it as? By the way, there is a name also. Okay. When the carrying cost exceeds the benefit of holding commodity. Everyone. So the forward curve experience, the spot price is below the forward price. Carrying cost exceeds the benefit. There is an upward sloping forward curve, or the forward curve experiences backwardation. Please answer. A. I've got A as an answer. I want to see what all answers you have. I have the forward. There is an upward sloping forward curve. See, when the carrying cost exceeds the benefit of holding the commodity. So if this is a situation where the cost of holding is higher, if the cost of holding is higher, there should be an upward, the forward prices should be greater than spot. Am I correct? Right? If the carrying cost exceed the benefit of holding. Okay, so the costs are higher than the benefit. Whenever the costs are higher, forward prices are higher than the spot. Am I correct? Just confirm, everyone. So whenever the carrying cost exceed the benefit, correct? The yield curve, what is yield curve? Yield and maturity normally for our bonds, right? Here, what will be happening in the situation? The yield curve will be, the forward prices will be higher and higher and higher. Am I correct, everyone? So the forward prices will be, first of all, will it be in contango or backwardation? They will be in contango. Understood, everyone? So whenever the cost is higher and the benefits are lesser, the forward prices will be relatively higher. Okay. So the forward prices will be greater than spot price. But on the opposite, when the benefits are higher, what will happen? When the benefits of holding a derivative instrument is higher, then the forward prices will be relatively less. Everyone with me on this? Clear? So, what should be the answer? A, B, C. Benefits, and they are asking you benefits and cost. Yes, let me know. I have got one answer. Okay. Yes. Anyone? Anyone? What about the others? A. Okay. Now, the answer yes, forward prices are greater than spot. That means it's a contango, and therefore there is an upward sloping forward curve. Please mark this star. There is an upward sloping forward curve. All right, everyone. Check, check, check. Perfect. It's called contango. If a commodity futures market is in backwardation, if the market is in backwardation means what? The forward prices are below the spot. The commodity has a high convenience yield. Convenience yield is a benefit. Convenience yield is a benefit. It's a non-monetary benefit. Okay. Yes, that's true, isn't it? Everyone, the high convenience yield means the benefit is high, so the forward will be lower, which is a backwardation, isn't it? The long futures position will have a negative roll yield. Roll yield is when you roll one contract, you exit one contract and enter into another contract. Since the market is in backwardation, when you exit the contract, you sell at a higher price and you buy the new contract at a cheaper price because the forward prices are going down. So in that case, you rather have a positive roll yield, not negative. And the future price of the commodity is higher than spot? No, it is going to be lower. So the answer is A. Everyone with me? All right. Yes. The convenience yield of a commodity is best described, guys. In commodities, you don't have a monetary benefit like dividend. In commodities, you have a non-monetary benefit of holding the physical asset or physical commodity. So is best described as a benefit. Yes, that will reduce the forward price. Am I correct or not? Benefit that will reduce the forward price is the answer. Correct? Being directly related to the commodities inventory levels, no, has a cash benefit from holding a physical commodity. Guys, there is no cash benefit. It's a benefit of holding the physical commodity, and it's not a cash. I repetitively told you it's a non-monetary benefit. No one is going to pay you actually. It is a non-monetary benefit, and that's why you cannot say it's a cash benefit. Please make this clear. Convenience yield is, I'll repeat, it's called a non-monetary benefit. Okay. Next, which of the following types of alternative investment is most likely to provide steady cash flows? Farmland, timberland, or raw land? Everyone. Comparatively, it is going to be farmland, right? Because you can lease the farm and generate crop, from that crop you can yield something. So farmland is actually going to be relatively going to give me steady cash flows compared to timberland or raw land. Raw land does not generate any cash flow. Cash flow is only generated if you're going to sow something on that farm. Timberland, yes, it does generate, right? So timberland, in case if they choose to sell this timber, then you can. But compared to that, farmland generates regular cash flow. All right. If a commodity's convenience yield is close to zero, that means there is no benefit, only cost. The future market for the commodity will be, see, if there is only cost, the future will be greater than spot, then it is what we call as happily, what we call it as, everyone in the class, we call it as, come on, you cannot make a mistake on this. Everyone in the class, come on, if you make a mistake, my heart will break. It is contango. Why? Because there is no benefit. So assume whether cost is there or not, forward will be greater than spot. All right. Check, check, check. See, you see so many these types of similar questions. Correct. Okay. Now we go into the hedge funds, the last theoretical topic of hedge fund, and then you have digital assets. Hedge funds, a typical trade used by a merger arbitrage fund. What merger arbitrage funds do? They buy and sell. They do long and short. They long the target company and they short the acquirer because they think the acquirer is making a mistake. The target, they always overpay the target. So they typically do what? They long the they long the target company, and they short the acquirer because they think acquirer is going to overpay, which typically happens in a merger. So is going to be short acquirer and long the firm that is being acquired or target. True, isn't it? That's what they're going to do. Correct, everyone? Okay. The period within which a hedge fund must fulfill a redemption request. Guys, in hedge funds, when you put up a redemption request, they are not going to immediately pay you. They will tell you, okay, wait, and we will pay. Everyone, lockup, notice, or withdrawal period. There's nothing like withdrawal period. It's called a notice period. Same like your company, they won't release you immediately, right? After your resignation, you'll have to serve the notice period. So same way here, it is a notice period. All right. Lockup period is where there is no redemption allowed. After the redemption date expires, the redemption lock-in expires. After that, even if you put redemption request, you will have to wait for the notice period, 15 days, 30 days. Then you will exit. Then you will get your money back. Okay. The terms of a hedge fund are least likely to be stated in a private placement memorandum. Can you do it in a private placement memorandum? Yes, you can. Partnership agreement or side letter. They are saying the terms of the hedge funds are least likely to be stated in a private placement memorandum, partnership agreement, or side letter. C. The answer is yes. Anyone would want to try? It is side letter. Side letter is a special additional provision for some specific investor. It's not a general agreement. It's only when some, let's say, a big HNI investor like Elon Musk joins the fund. So then we will give him some special benefits or some special structure will be made for it. That's a side letter. It's not a general agreement. So private placement memorandum or partnership agreement, they are general in nature. Side letter is for a specific investor. Understood? 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 Ownership rights to physical assets. This is from digital assets. Very important. This one that I've chosen. For physical assets, how do you get the ownership on a DLT technology, distributed ledger technology of blockchain? What is that called as? Physical assets, digital ownership. What is the name of it? It is called tokenization or token. Please mark this. Token is what? Token represents the ownership of physical assets in a blockchain or a DLT, distributed ledger technology, or in a digital manner. All right. Now, on the contrary, they said something about smart contracts. Smart contracts are basically computer programs that can execute contracts. So you don't need to do physical contracts. You can execute the contract. So when it comes to like options, smart options, so automatically the option will be executed. That's a smart contract. Understood, everyone? Check, 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 check. Would you want to try the last one? Which type of cryptocurrency related vehicle invests directly in cryptocurrency? Which is the way through which you can directly invest in cryptocurrency? Cryptocurrency futures contract, cryptocurrency ETF, or cryptocurrency coin trusts? ETF is never a direct investment. ETF, you are investing in ETF, ETF is investing. Which one? Cryptocurrency futures contract? No, it's a derivative. It is a cryptocurrency coin trust. Very interesting concept it is. Here, what happens? See, ETF and futures are not direct exposure, they are indirect exposure. Cryptocurrency coin trust, they're actually a large pool of cryptocurrencies. So when a large pool of cryptocurrencies come up together, that's called a cryptocurrency coin trust. Here you are still a direct investor, but ETF and futures are not. Understood? Everyone? Clear? All right. That's it about alternative investment. Very short, sweet, easy topic. Do expect calculation related to hedge fund at least one or two. Lucky if you are, you'll get two, but I don't think so. You'll get two. Most of the questions are from the first topic where there is so much of information. All right. Perfect. Everyone. Yes.